What's up, guys? Welcome back. So last week's video got amazing feedback. It absolutely blew up, breaking channel records all over the place, views, watch time, you name it.
Are you not entertained?
And one of the most exciting things for me as a creator when videos like that do so well is the comment section. Inside that comment section, I got so many incredible questions, comments, and it just leads to more content like this. It's kind of like a follow-up, because I said something inside that video and in the comment section that really sparked people's interest, and that was the fact that I never really plan on buying 100 shares outright of a stock ever again. Now, that statement alone made people be like, what do you mean you're never going to buy 100 shares ever again? And then I followed it up with, and when you buy an option, that sometimes the max loss is not the premium that you paid, and that just made people's minds explode. It's pretty common, rule of thumb that we know that the max loss when you buy an option is the premium paid, but that is not going to be the case in what I'm about to tell you. If you believe that, then you don't know the information that I'm about to teach you, and this is going to be super valuable for you. And the last wonderful thing is this is not going to be some next level ish that you have to be an options expert to understand. You can literally do this tomorrow. I explained this to a couple of people in my Discord after last week's video, and they already started making money. They pretty much oh, thanks a lot, Brad. I made back my Discord donation in 1 week. Yes, that's exactly. So you don't have to be next level to understand what I'm going to show you today and why I'm never ever going to buy 100 shares outright ever again, really. Unless there's I guess I'll never say never, all right? There's a very, very good chance that I am not going to be buying 100 shares of a stock ever again. So really what I'm going to be talking about is a LEAPS in this video, a long-term equity anticipation securities. I've seen so many videos about it, and really with the exception of Adam over at In the Money, I've never really heard anybody explain it the right way. Right? People just explain it as a really, really long call option that's far out in expiration, that's really, really deep in the money, but they never compared it to owning 100 shares of a stock and showing that owning 100 shares of a stock versus a LEAPS is really the same exact thing, same exact leverage, same exact position, but you're going to get it at a fraction of the price. So to really show that, guys, you guys know that I've been loving the digital whiteboard, showing you things visually. I want to get down. I want to show you. I'm going to show you an example. Hear me out. Don't rush away from the video because you hate options or because,
oh my God, this is so expensive.
But yes, guys, it costs money to invest in the stock market. But like I said, as you're going to see, as opposed to 100 shares of owning, this is a basic stock, as compared to owning 100 shares, this is going to be half the amount of money to do so. And you're going to get the exact same benefits as owning the 100 shares. I wish you guys knew really inside how excited I get when I'm about to show this, because I know that I'm going to help so many people. Okay, this is Starbucks right here, guys. And as we can see, we are going to be buying a call option. So yes, we are going to have to pay some premium, but that premium is not going to be our max loss. Our max loss is actually going to be defined. There's going to be no ifs, ands, or buts about it. When you enter this contract, you are going to know exactly what the worst case scenario is. And as we can see, expiration, guys, January 20th, 2023, exactly 2 years from today. I know it LEAPS, right? We want to go more than a year, but the further we can go out, the better, because we don't want to have to worry. Like I said, we want this to replicate owning 100 shares. So we don't want to be worrying about things like expiration. And we pretty much can, it's safe to assume that this is going to go up over the price of 2 years. We're definitely going to choose a stock we think is going to go up over the course of 2 years. That's I don't know, options 101. You want the stock price to go up if you're going to be buying a call. So there's a couple of things here that I'm really going to reference and focus on. One is going to be the current share price, which is $105.75. Next is going to be the strike price that I've chosen. As we can see, this is deep, deep, deep in the money. And yes, that is going to increase the premium that we need to put up. But if you know a little bit about intrinsic versus extrinsic value, which I will refresh, you'll understand why it's more money. It has to be for going deeper in the money. Over here is going to be the premium. So this is in premium term. So essentially what we are going to have to put up is $5,598. That is going to be our upfront cost for this option over the next 2 years. But here, guys, delta, right? Delta is pretty much, it's the likelihood that this particular option is going to expire in the money, right? A pretty rough estimate. So this has a 97% chance of finishing at 2023 in the money, but it also is a good indicator of pretty much the amount of shares. It's, how many shares this kind of represents. So here, 97, which is damn close to 100. We're going to get all the benefits of 100, but really 97. And that's those things we're going to compare. We can mention the fact that data is almost nothing, but we understand that because we are so far to expiration. So I've said it a few times. Now let's break it down. The fact that even though you're putting up $5,598, that is not going to be your max loss as compared to owning 100 shares. I'll explain.
Would you like me to explain?
First, what I'm gonna do is I'm gonna write the premium here. The premium is going to be $55.98. And we just explained that in terms of dollar amount, that's really $5,598. Now, guys, if you don't know that this premium is split into two things, intrinsic value and extrinsic value. And we are going to see throughout this video that this right here is going to be our max loss as compared to owning 100 shares of the same exact stock at this share price. Now, the intrinsic value, the amount of money that if you were to exercise right now, this is the profit you get. It's essentially how far in the money this option is. So right now, we can calculate that intrinsic value very, very easily. All we have to do is we take the share price, $105.70, and we minus it from the strike price. So that gives us an IV that's equal to $55.70. So of that $55.98 that we're putting on premium, $55.70 of that is intrinsic value. That's profit that we can get if we were to get in and write out and close it. That's the profit we get right back. So even though we're putting up that money, that's essentially ours. We could get that back right now if we were to close this option. The intrinsic value is how much you can exercise right now and the profit that you'd receive. Now, the extrinsic is everything else, which we see is just 28 cents or $28. Guys, this is really our max loss inside this option. And I'm going to show you, we can even mitigate that to almost nothing. Okay, so let's assess the risk, okay? Because I know everyone's always worried about the risk when it comes to options. If I own 100 shares and I own them at the strike price of $105.70, and it dips and it dives to our strike of 55. So now it's $50. How much did we just lose? Well, we just lost $55.70. We would lose the intrinsic value. This is what we would lose if we owned 100 shares of the stock and it dove from the current share price all the way down to $50. Now, in this LEAPS, what's the risk? What would we really lose? Well, for the LEAPS, at expiration, the intrinsic value is going to be equal to $0. The extrinsic value is also going to be equal to $0. So really, it's just a premium that we put up, $55.98. The only difference between owning the 100 shares and it dipping to 50 and owning the LEAPS and it dipping to 50 is $28 or this extrinsic value. The only difference between owning the LEAPS and owning 100 shares, if it dips to 50, is our extrinsic value. Just what I've been saying. It's $28. But there's a but. There's a but. If this were to continue down below 50, we would still only lose this, right? When we own that LEAPS, after it goes worthless, that's capped our loss. But this, if we own the 100 shares, it could essentially go down to zero. If this went down from 50 down to zero, we'd lose another $5,000. So there's more risk. Essentially, there's a lot more downside risk to owning the 100 shares. And it gets even better. It gets even better. This is the part in the video, in Adam's video, where he started to lose his mind. I'm going to link his video down below. It's really, really good. And he has a much different approach than me. Let's look at the difference in cost basis, right? So let's see, cost basis. If I want to own 100 shares of this, if I want to purchase this 100 shares, right, it's going to be the share price times 100. That's going to be a cost to own 100 shares of $10,570. That is a ton of coin. But what's our LEAPS cost basis? Once again, just the premium that we put up. So by owning the LEAPS with more downside protection and less money and only risking $28 more to do so, we are going to save a difference of $4,972. So you're getting all of the benefits essentially of holding 100 shares, and you are going to save yourself $4,972 that you can now go use to try and make up this $28 over the course of 2 years until 2023. think you could do that? Do you think if I gave you $5,000, you could figure out a way to make $28? I mean, what percent return would that be? So let's see. If we took this $28 and I divided by the difference in the cost basis, that is going to be a 0.56% return. Do you think if I gave you $5,000 in the next 2 years, you could get a return of 0.56? Because if you think you can, it is once again better to own this LEAPS than to purchase 100 shares outright. And for those that really have a firm grasp on extrinsic value, you know that this is the max. This $28 only exists at expiration. Up until expiration, it's going to be less than $28 because you'll probably be able to recuperate some of that extrinsic value if you were to sell to close this option. You can see, guys, this is not crazy. It blows my mind when people just push off options and are like,
It's too risky, it's too expensive, I could lose all my premium.
like, look, guys, it's just math. And how did all of this relate to the other video, guys? The one last thing about this LEAPS, if you did not happen to see that video, I'll definitely link in the comments. Go back and see it. Like I said, 20,000 views in 1 week, which is unheard of for my channel. When you own this, all right, and you have level 3 enabled options. So people ask me this like, oh, Brad, I can't do this from the video. You have to ask your brokerage, you know, you have to be allowed to use options. And this is essentially going to be a form of a spread, which I'm about to tell you. So if you're in Robinhood, I think it's level 3. I don't know what it is for everything else, but you have to be able to trade spreads. Guys, if you have a LEAPS that's out for 2023, when I make mine, guys, I don't usually even go to 9.7. I'll go to like 7. That's 0.7 delta is okay for me for my LEAPS going out that far. But essentially what I could do is now sell covered calls against this. That's called a poor man's covered call. And I can promise you in that one covered call, I'm going to make this intrinsic value back right there. So literally in one covered call, I am going to make back that extra. And if you don't know what that is, like I said, go back. That's what that last video was on, the poor man's covered call. I've been racking my brain to try and figure out some cons. If it's a dividend stock, right, in this, you're not going to be collecting the dividends, okay? So maybe if this was like a dividend hold, maybe this wouldn't be the best play. But like I said, I'm not saying that I'm not going to own 100 shares. I said I'm not just going to go out and buy 100 shares, right? I dollar cost average. My portfolio has 100 shares of things that I'm selling calls against. But I'm saying like going into Robinhood or going into my brokerage, going into Vanguard and saying, today I'm going to purchase 100 shares, never going to do it again. I'm just going to do this. And after I do it, I'm going to sell calls against it. I'm going to collect premium, which is going to lower my net premium paid, which is going to get me closer and lower my break even. Like, guys, the pros are amazing. As long as you really understand that the most you can lose as opposed to owning 100 shares of the exact same stock is just the extrinsic value, you're golden. People also asked me last week if I could open some more premium spots. I opened 25. I think there's probably like 10 left. If you want to get into the Discord, guys, this is the stuff we're talking about every single day, right? You will make back your Patreon donation. I promise you, you will get that back. Actually, I'm not going to promise. I can't promise. You are going to get that premium back most likely. I'll leave a link down for the Discord and Patreon down below if you want to join that conversation. If you haven't gotten the 4 free shares, I know you've heard about it from Weeble. You know, get the 4 free shares and then take the money out. Whatever, it's free. It's 4 free shares. It's like at least $20. I'll leave that link. And guys, get down in the comments below. Leave me some more future content that you want me to do just like this. If you want me to explain anything, I'd be glad to do so. And until I see you guys in the next one, stay positive, work really, really hard. Always, please be kind to other people. Hope you have yourself an amazing day and an even better tomorrow.